Goodwill. It's a term you might have heard tossed around in accounting classes or business meetings, but what does it really mean? And why should you care? Well, today we're diving deep into the world of goodwill, an essential asset in accounting that often gets misunderstood, misrepresented, or simply overlooked. Trust me, by the end of this monologue, you'll have a clearer understanding of what goodwill is, how it's used in accounting, and the potential pitfalls that come with it. Let's start with the basics. Goodwill is an intangible asset that represents the value of a company beyond its tangible assets. Think of it this way: when one company buys another, they're not just acquiring buildings, inventory, and equipment. They're also buying the reputation, brand recognition, customer loyalty, and even the intellectual property of that company. All of these factors create what we call goodwill. So, when a company is purchased for more than the fair market value of its net assets, that excess amount is recorded as goodwill on the acquiring company's balance sheet. Now, you might be wondering, what exactly contributes to this goodwill? Well, it can arise from a variety of factors. A company that has spent years building a strong brand name through effective marketing and advertising will have significant goodwill. Customers tend to trust brands they recognize, and that trust translates into customer loyalty and repeat business. This is where the power of goodwill shines. It's not just about what a company owns, it's about how the market perceives it. According to accounting standards like US GAAP and IFRS, goodwill is considered an intangible asset with an indefinite useful life. This means it doesn't get amortized like other assets. Instead, companies must evaluate it annually for impairment. If a company finds that its goodwill value has decreased, it must recognize that loss, which can impact its financial statements significantly. This brings us to a critical point. Goodwill is not just a number on a balance sheet, it's a reflection of a company's reputation in the market. Let's talk about some other names you might hear associated with goodwill. You'll often hear terms like reputation capital, brand equity, or customer relationships. Each of these terms encapsulates a different aspect of goodwill. Reputation capital, for instance, refers to the value a company earns through the quality of its products and services, which fosters customer trust and loyalty. Brand equity, on the other hand, represents the value tied to a brand name, logo, or trademark. And let's not forget about customer relationships. These are vital for any business, as they encompass the lifetime value of customers, acquisition costs, and retention rates. So, what role does goodwill play in accounting? First and foremost, it's crucial for the valuation of a company. When investors are considering putting their money into a business, they want to know its overall worth. A high amount of goodwill indicates that a company has a strong reputation and brand value, which can influence investment decisions. Goodwill also plays a significant role in mergers and acquisitions. When one company acquires another, the goodwill recorded on the balance sheet reflects the premium paid for the acquired company, signaling valuable investments that can generate future cash flows. Now, let's delve into the two types of goodwill recognized in accounting: purchase goodwill and internally generated goodwill. Purchase goodwill arises when a company acquires another entity and pays more than the fair market value of its net assets. This is typically seen in mergers and acquisitions. On the flip side, internally generated goodwill refers to the reputation and brand value a company builds over time through its operations, marketing, and customer service. However, it's essential to note that internally generated goodwill cannot be recognized on a company's balance sheet under generally accepted accounting principles. Still, it can enhance a company's market value and contribute to its long-term success. You may be wondering, how do we calculate goodwill? It's actually pretty straightforward, although it does require some detailed analysis. The formula is simple: goodwill equals the purchase price minus the fair market value of the assets acquired. For example, if a company is acquired for $10 million and the fair market value of the assets is $6 million, the goodwill would be $4 million. This calculation is vital for understanding the value of goodwill and how it contributes to a company's overall worth. But, like everything in life, goodwill comes with its advantages and disadvantages. On the plus side, goodwill can enhance a company's value, improve access to financing, and provide a competitive edge. Companies with strong goodwill are often more attractive to investors and lenders, leading to better financial opportunities. Additionally, a solid reputation can help retain customers and foster long-term growth. However, there are also drawbacks to consider. The valuation of goodwill can be quite subjective, relying heavily on estimates and assumptions that can vary widely. There's also the risk of impairment. If a company's goodwill is deemed to have decreased in value, it must recognize an impairment loss, which can significantly impact its financial statements. Plus, goodwill is an intangible asset, meaning it's not backed by physical assets or cash flows, which can make it feel less tangible compared to other assets like property or equipment. Now, let's touch on how goodwill differs from other intangible assets. While goodwill is a unique intangible asset that reflects a company's overall reputation and brand value, other intangible assets like patents, trademarks, and copyrights are often more straightforward to quantify. Goodwill is often seen as a residual value, the difference between the purchase price and the fair market value of identifiable assets, while other intangible assets typically have a clear development cost associated with them. When evaluating goodwill, several factors come into play. The company's reputation, brand recognition, customer loyalty, and relationships with suppliers can all influence the value of goodwill. For instance, a company with a stellar reputation for quality products will likely have higher goodwill than one with a tarnished image. Similarly, strong customer loyalty can drive up goodwill, as repeat business and positive referrals are invaluable to a company's success. Now, let's not forget about the impact of goodwill on a company's financial performance. Goodwill can lead to increased asset value, improved reputation, and enhanced financial stability. Companies with high goodwill can weather economic downturns better than those with low goodwill, as customers are more likely to stick with brands they trust. Moreover, Goodwill can provide valuable insights for management, helping them make informed decisions about investments, mergers, or acquisitions. So, how is Goodwill recorded in financial statements? It's recognized as an asset on the balance sheet only when acquired through a business combination or merger. The process involves identifying the purchase price, calculating the fair value of the acquired business, comparing that fair value with the purchase price, and then recording the resulting goodwill as an intangible asset. This goodwill is then subject to annual impairment testing to ensure its value remains accurate over time. However, evaluating goodwill isn't without its challenges. Determining its value can be tricky, as it often relies on estimates and subjective judgments. External factors, such as shifts in consumer preferences or economic conditions, can also impact goodwill value, making it fluctuate over time. Plus, the accounting methods used for evaluating goodwill can differ, leading to inconsistencies in valuation and complicating comparisons between companies. To manage these potential risks, businesses can implement several effective strategies. Establishing clear evaluation criteria, hiring independent appraisers, conducting thorough due diligence, and monitoring goodwill regularly can all help mitigate the challenges associated with evaluating goodwill. In conclusion, goodwill is a powerful intangible asset that can significantly enhance a company's value. It reflects a business's reputation, brand recognition, and customer loyalty, all of which contribute to its overall worth. While goodwill can provide numerous advantages, it also comes with its share of challenges and risks. Understanding goodwill is essential for anyone involved in business, whether you're an investor, an accountant, or a business owner. By grasping the complexities of goodwill, you can make more informed decisions that can positively impact your financial future. So, the next time you hear the term goodwill, remember, it's more than just a number, it's a reflection of a company's identity in the marketplace.